Picture this. You absolutely crush your quarterly earnings estimates. You raise your guidance for the entire year, and your reward? Watching billions of dollars of your company's market value completely evaporate in a matter of minutes. That is exactly what happened on July 15th, 2026. The stock market, well, it's rarely perfectly rational, but this kind of violent disconnect, it sets up a fascinating financial mystery. We're looking at a massive valuation gap today that demands an explanation.
Look at this number. This is what flashed on screens and gave investors serious whiplash. A 10.58% plummet in pre-market and early trading for Elevance Health. It wiped out a staggering amount of market cap. But here is the crazy part. They didn't just beat analyst estimates on the top and bottom lines. They actually raised their full-year earnings guidance to at least $27 a share. So what on earth is the market seeing under the surface that triggered a sell-off this massive? To understand if this is a permanently broken business or just a drastically misunderstood opportunity, we need to look at what's actually driving the machine.
Section 1. The Core Business Engine. Now, when most people hear the name Elevance Health, they just think, oh, it's an insurance company. But they're really a massive, vertically integrated healthcare compounder powered by two distinct engines. In Q2 of 2026, their traditional health benefits segment brought in $42.7 billion in operating revenue. That's your classic risk-based insurance, taking on the risk of paying for medical care in exchange for premiums. But the second engine, that's where the real structural magic is happening, Carelon. This is their rapidly growing healthcare services platform, and it pulled in $19.2 billion. Carelon isn't a side hustle. It's their internal pharmacy benefit manager, their specialty pharmacy, and their clinical care provider. Why does this matter? Well, in the traditional insurance model, every time a patient fills a script or visits a clinic, the insurance company leaks money out to third-party providers. By building Carelon, Elevance is essentially selling services to its own insurance arm. They're capturing that healthcare dollar, keeping it inside their own ecosystem, and turning what used to be a pure expense into a high-margin internal revenue stream.
What's really wild is the structural moat protecting those revenues. In the insurance game, scale is literally everything. And Elevance, they hold the exclusive license to the Blue Cross and Blue Shield trademarks in 14 heavily populated states. That brand heritage gives them just incredible regional density. Because they control so many covered lives in those specific areas, they have immense negotiating leverage. They can literally walk into a hospital system and demand massive provider discounts that a smaller insurer just cannot get. Combine that monopoly-like regional power with insanely high switching costs. Think about their digital infrastructure, like HealthOS. This software gets deeply integrated into corporate payrolls for employer-sponsored plans, and it's hardwired right into hospital billing records. Imagine you're an HR director at a massive corporation. Unwinding Elevance from your entire payroll system is an operational nightmare. That friction creates a wildly sticky ecosystem for their nearly 45 million members.
And you can clearly see how that moat translates into real market power. In a multi-trillion-dollar, highly consolidated U.S. healthcare market, Elevance consistently holds its ground against the absolute titans. They command a 12% commercial market share. That ties them with CVS Health, puts them right behind the giant United Health at 16%, and they completely tower over government-focused players like Centene down at 3%. The key takeaway here isn't just the size, though. It's how they maintain it. They don't win by fighting unprofitable price wars or slashing premiums to the bone. They win through disciplined pricing and unparalleled regional scale. They basically view their total addressable market as the entire employed and government-insured population of those 14 core states. And they focus on maximizing profitability right there, rather than chasing unprofitable growth outside of their footprint.
Section 2. The Earnings Disconnect. If you only read the headline numbers on July 15th, you'd think Elevance just executed a flawless quarter. Across the board, things looked spectacular. Operating revenue hit $49.8 billion, easily blowing past the $48.6 billion Wall Street was looking for. That was driven by solid premium yields and Carelon just continuing to expand. And then, look at the adjusted earnings per share. An absolute crush, $7.45 against a consensus estimate of $6.21. That is a massive beat for a mature, highly predictable healthcare company. On the surface, the core business engine looked like it was humming perfectly. It created the illusion of a flawless quarter, which is exactly why a 10% market haircut seems completely insane at first glance.
But here's the reality check that spooked the market. You've got to look under the hood. A huge chunk of that EPS beat, 80 cents per share to be exact, was a one-time valuation adjustment in net investment income. Look, insurance companies hold massive investment portfolios, and this was essentially just a mark-to-market accounting benefit. It wasn't operational. They didn't earn that 80 cents by selling more insurance or managing care better. It was just a spreadsheet adjustment. Meanwhile,
Over on the right side here, the actual operating margin in their core health benefits segment completely collapsed year over year, dropping from 3.8% down to 2.1%. In the insurance world, everybody watches the medical loss ratio, the percentage of premiums paid out in claims, and that ratio spiked. Medical costs were rising significantly faster than the premiums they were collecting, heavily compressing the profitability of their main engine.
So the bear case here, it's actually highly intelligent. Investors are terrified of three distinct things. First, post-pandemic Medicaid redeterminations. During the pandemic, states paused checking if people were still eligible for Medicaid. Now, they're aggressively kicking people off the rolls. The healthy people who got jobs are leaving, meaning Elevance is left with a pool of significantly sicker patients. Higher acuity means higher clinical cost, period. Second, there's a serious lag. State governments set Medicaid premium rates on an annual cycle, and they just haven't adjusted those rates fast enough to cover these newly elevated costs. Elevance is eating the difference. And third, looming in the background is a terrifying $935 million Medicare Advantage regulatory overhang. The government did a Q1 risk adjustment audit, essentially accusing insurers of exaggerating how sick their Medicare patients are to get higher payouts. The market looked at the potential for nearly $1 billion in clawbacks and just lost all confidence in the predictability of Elevance's government business. And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed.
Section 3. The Qualitative Scorecard. When we strip away the short-term panic and just look at the actual business quality, Elevance earns a very solid blended score of 8.0 out of 10. Guys, this is not a broken company. Capital allocation is a massive standout here at 9 out of 10. Management didn't just sit on their hands while the stock dropped. They aggressively bought back $1.36 billion in shares in the first half of 2026 alone. They pay a healthy, growing dividend, and they're constantly reinvesting cash flow into smart M&A to expand Carelon. Management alignment scores an 8. CEO Gail Boudreau is heavily incentivized with long-term equity, meaning her own net worth is directly tied to steering the ship through these exact types of regulatory storms. Now, profitability does take a slight hit, sitting at a 7 out of 10 because of those suppressed gap margins and the medical loss ratio spike we just talked about. But the overall revenue quality, it remains incredibly recurring. People and governments pay their health insurance premiums every single month, without fail. Overall, this is a structurally healthy, disciplined business that is experiencing a cyclical margin squeeze, not a fundamental collapse.
All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, quality businesses built to compound for years; hidden gems, under-the-radar names with asymmetric upside; dividend hunters, durable income with the fundamentals to back it up; Portfolio Watch monitors your portfolio and flags important changes; and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Section 4. Scenario Analysis Framework. Before we dive into the numbers, I need to clearly state, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Using the post-crash price of $381.62 as our baseline, we project out 5 years to 2031. Factoring in a 60% probability for our base case and 20% for both the high and low cases, we arrive at a probability-weighted target of $720.24. That implies some massive asymmetric upside if management can just steer the ship back to its historical baseline. But we definitely need to talk about that low case for a second. It's sitting there with a 20% probability at $412.44. What happens if things go totally wrong? While this scenario assumes state governments absolutely refuse to hike Medicaid premiums to match the sicker risk pool, permanently suppressing margins. It also assumes the government aggressively claws back that $935 million in Medicare Advantage audits, permanently impairing their growth in the senior market. In that world, earnings basically stall out, the multiple compresses even further, and annualized returns are basically flat for 5 straight years. But let's look at what actually has to happen operationally for our more likely targets to make sense.
In our 60% base case, targeting $740.27, we aren't assuming miracles here. We're really just assuming a return to a normal macroeconomic and regulatory environment. We assume the Medicaid margin pain bottoms out in 2026 and recovers to a historical norm of around 2% by 2028. Why? Because state premium updates eventually have to catch up to the reality of the medical costs. We also assume their current 2026 to 2027 AI transformation plan actually works. By using AI to automate prior authorizations, streamline claims processing, and reduce administrative bloat, they can protect their bottom line even if premium growth slows. Operationally, that combination of margin recovery and AI efficiency drives Year 5 adjusted EPS to $47.76. Apply a highly normalized, historically standard 15.5x multiple to that earnings power, and you get a 93% total return over 5 years. It's a remarkably grounded assumption for a near-double return.
And just briefly on the high case, this requires flawless execution and a nice tailwind. This happens if Carelon's high-margin pharmacy and clinical services don't just serve Elevance, but successfully capture an even larger chunk of independent, third-party clinical spending. If they can scale Carelon rapidly while simultaneously pushing Medicare Advantage margins up to a robust 3.5% through superior patient risk management, the market is going to reward them. Excellent execution of that dual-engine strategy earns them a premium 17.5x multiple. That pushes the share price to $967.97, delivering an incredible 20.39% annualized return for a highly defensive healthcare giant.
Section 5. Primary risks. When you're assessing risk in the managed care space, it is absolutely vital to separate temporary cyclical pain from permanent structural impairment. A rough seasonal flu, a temporary lag in state Medicaid rate updates because of sluggish legislation, those are short-term mismatches. It's noise. It definitely hurts the quarterly earnings, but it doesn't break the multi-year compounding machine. But what about structural danger? If antitrust regulators ever successfully forced a breakup, or they somehow lost their exclusive Blue Cross Blue Shield trademark licensing in those 14 core states, their negotiating leverage with hospitals would just evaporate. Or what if there's massive federal legislative reform? If Congress were to implement sustained, multi-year managed care margin caps, literally legally limiting the profit these companies can make off government programs, that would fundamentally alter the cash flow profile of the business forever. That's the kind of structural risk you have to watch out for.
And that brings us to a very specific decision-useful metric you should track on every single future earnings call to monitor that risk. Days in Claims Payable, or DCP. Look, insurance is ultimately a float business. This metric measures how long Elevance holds on to premium cash before paying it out for medical claims. The longer they hold it, the more interest they earn. Right now, it's very healthy at 45.4 days. That's up almost 3 days from last year, meaning they have solid reserves and strong balance sheet flexibility. But if you ever see DCP drop below 43 days, pay close attention. That is a severe early warning sign. It means medical claims are accelerating much faster than premiums are coming in, forcing them to burn through their cash reserves under extreme stress. If DCP cracks, the entire thesis cracks.
Section 6. Final takeaways.
Here are the 3 most critical takeaways you need to remember. First, the Medicaid margin pain that caused this massive sell-off appears to be a cyclical trough, not a structural collapse. The sicker risk pool is a painful reality right now, but state rate adjustments will eventually, inevitably, catch up to clinical acuity. It's a matter of when, not if. Second, do not underestimate that second engine. Carelon is a vital, high-margin asset that keeps healthcare spending inside the Alansman ecosystem. It protects the company from third-party value leakage and acts as a massive buffer against pure insurance underwriting risks. And third, because of the market panic over these temporary headwinds, the stock is now trading at a 14.1x forward PE based on their raised guidance. Compared to their historical averages and industry peers, that represents massive multiple compression.
Which leaves us with the ultimate question. Has the market accurately priced in a permanently broken business? Or is it violently overreacting to a temporary speed bump for a deeply undervalued healthcare giant? The evidence we've walked through today strongly points to the latter. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.